So this is a great question. So if you missed my last video, I covered off a cheat code for business owners who can build a substantially valued business and sell it without any tax. But the question is, well, what do we do with it once we've got the money sold? And how do wealthy people take money from their business and build tax effective wealth? And there's a few ways for us to do it. So the first, and I believe the best for long-term financial planning, is the superannuation system. Now, I know that many people throw shade at the superannuation system, but quite frankly, we have the best superannuation and retirement planning rules that exist in the developed world. There is nowhere else in the world whereby you can contribute money to a retirement savings scheme and claim a full tax deduction on contributions up to $27,500 a year. Secondly, if you haven't met those contributions for the last 5 years and you've got a balance of less than $500,000, you can do what's called catch-up concessional contributions, and all of those contributions that you make can be tax deductible, and you can time that in order to coincide with some other CGT event. Let's say you sold an investment property. In many cases, we've used that strategy to avoid our clients having to pay any tax on those transactions as well. Now, once that money is inside superannuation, earnings are taxed between 10 and 15%. And basically, if we get to age 60 and we convert all of that retirement savings into a pension, all of the earnings on that pension are tax-free, and you can draw an income stream completely tax-free as well. Now, of course, the preservation age is 60 or older. So we need to ensure that we are also building tax-effective wealth elsewhere. This is where we start using trusts and companies. So for most of our clients who have built a substantial amount of wealth, they have what's called a family trust. And a family trust provides us with flexibility around how we distribute income and capital gains on an annual basis. So we've got people who are in the family who have lower incomes and we can utilize their marginal tax rates. We have the ability to distribute that income and capital gain in order to maximize that. But they typically get to a point where the family is earning more than, say, $500,000 or $600,000 a year. We've maximized all of the marginal tax rates for the individuals, and we've got them to a point where they're all paying 30% tax. Then we start utilizing what we call a bucket company. And a bucket company is basically a beneficiary of the family trust. It allows us to distribute excess profits at a flat rate of 30% tax, and we invest in that bucket company in order to cap our tax rate, because the idea of the game is to pay no more than 30% tax. The last strategy that we've got is what's called an investment bond. I recorded an in-depth video on it the other day. If you're interested in getting a fact sheet, feel free to jump in the comments. But an investment bond is taxed like a bucket company. So it pays a flat rate of 30% tax on any earnings that it produces. But if you hold that investment bond for more than 10 years, it becomes completely capital gains tax free. Now, if we couple that strategy with a very tax efficient investment such as an index fund, an index fund typically doesn't turn over its portfolio, so it has unrealized capital gains. So we're not taxed on any of those unrealized gains inside the investment bond. We hold the investment bond for then over 10 years. And then if we do sell down that portfolio, use it to create an income stream, there is absolutely no taxation on that investment. So for many of our clients, when they've implemented an investment bonds using index funds, their average taxation inside the bond can sometimes be equivalent to superannuation. So it's a pretty cool way to build wealth. So these are just some simple strategies that rich and wealthy people use with their proceeds in order to structure it appropriately so they optimize their tax liability and they don't pay any bonuses to the ATR. If you got any questions around how to build tax effective wealth, feel free to let me know in the comments. If you like this video, drop me a follow, and we'll catch you guys soon.